Drive carefully. Yeah, thanks, Richard. So yeah, I would echo a couple of things. Just thank you so much for the turnout, and it isn't a topic that normally in normal times really should be exciting. You don't want bonds to be exciting. That's '08 they were exciting, but not for a good reason. But we think we might be on the cusp of getting a little more challenging. So I'm going to talk about that. There's a few things I want to cover, but these events that we've been doing, it's very helpful if you're interactive. You have questions, you can throw them out. Don't feel like you have to wait till the end. We will have a question and answer at the end, but feel free to jump in at any time. So here, what I'm going to talk about today is just going to give a brief primer on bonds. I'm sure most of you know how they work, but I just want to kind of refresh and talk about the current rate environment. But big highlight is why we think moving forward things may be different in terms of compared to what's happened in the past with bonds. So meaning higher risk potentially. And we're going to go through why that is. And then what we would suggest is maybe some strategies to kind of manage through that process. So, bonds versus stocks. I think most know that bonds represent the debt of a company versus the equity. So essentially you're lending money to either a municipality, to the U.S. government, to a corporation, versus participating in the growth and the ownership of the company. So what that really means from our perspective is there's a lot of times when we may own debt of a company, for example, but not feel comfortable with the equity and how the company, but we know they can pay off their debt. Maybe it's a limited term bond and we can get a nice attractive yield, but doesn't mean we'd necessarily buy the stock of the company. So they are independent decisions. There's and I kind of should put in quote, perception of safe. So I think most people would say, what are the characteristics of bonds? And one of those would be they're the safe part of the portfolio, and they should be. However, again, we're going to talk about where moving forward, maybe there's, notwithstanding the last few days in the stock market, there may be more risk potentially in bonds than in stocks moving forward. And the spectrum of risk is similar. In other words, you can buy bonds that are extremely safe, U.S. Treasuries, some could argue that, all the way over to junk bonds or high yield. So by the way, when times are good, they call junk bonds high yield bonds. When they're bad times, they're junk bonds. So, and the same with stocks. Obviously, you can buy high quality blue chip, or you can put money in high flyers. So there's a whole risk spectrum related to bonds. Just a quick question. They might know which is bigger, the stock market or the bond market? Yeah, it's not a trick question, but how much bigger? So the bond market is quite a bit bigger. And it's actually twice the size. So if you put that in dollar terms, the total U.S. bond market's roughly $40 trillion, whereas equities, which is what gets all the news on CNBC, and that's what everybody talks about, it's actually half the size of the market, half capital being allocated. Pretty basic. What affects bond prices, and I would think of it as a fulcrum. So interest rates go up, bond prices will go down. The fulcrum, where that's placed, think of it as the maturity. So the longer term, the more pronounced the change in bond prices will be with slighter interest rate moves. And think of that simply as your capital is tied up longer at potentially a lower interest rate. So thus, when bond prices move one way or the other, they're going to tend to react more sensitively. And no secrets here, but obviously we're in a dismal rate environment. Doesn't mean it's been bad for bond performance. Bond performance has actually been quite good, which we're going to talk about. But if you look at where yields stand today, U.S. essentially risk-free rates at about 2%, which historically very, very low. 5-year CDs, if you're eager enough to go out and try to buy those at 1.5%. So anything that's essentially risk-free is extremely low. Driven by obviously what happened in '08 and the government keeping rates low, but really very much an anomaly. It's always been a time when most cases you get 4, 5, 6% risk-free rates of return. It's CDs or money markets, but obviously haven't been there for quite a while. That being said, if you look at the rest of the world, think how it would feel to be in Japan, 0.10% for their these are 10-year sovereign debt comparisons. So 10-year yields, United States is actually by and far the highest relative to most developed countries.
Where's Australia?
Australia is higher than, yeah, it's definitely, any of the more cusp of emerging, they're not really emerging, or emerging markets are going to be much, higher yield, obviously higher risk too. So why have bonds performed so well? This is a chart of the 10-year treasury yield over the last 20, 30 years, I guess. So we've had a really prolonged period of generally declining interest rates. We've had periods where it's bumped up a little bit, but draw a line across, it's been a big downward slope for a long period of time, which is very unusual historically. However, if you look at bond performance, and this is from mid 70s to current times, the blue bar is the annual returns on the kind of the go-to index, which is the Barclays Aggregate Bond Index. So positive returns in all but 3 years over the last 30, 25 years. And yet, when you look at the yellow bar of the Fed Reserve target rate being ramped down, and certainly now we know where it's been flatlined for a while. So one could look at this and say, well, maybe I shouldn't be as concerned about rising rates, because we've had, obviously in the 80s, periods of rising interest rates, and it really hasn't affected bonds negatively. So maybe I shouldn't be concerned about that moving forward. We're going to argue that maybe it's different, and for some reasons that I'll point out. This just kind of illustrates how sensitive bonds can be relative to rising rates. So a relatively short period of time where interest rates went from 2.33 yield on the 10-year or 20-year to 2.75. That's the price chart. So as rates went up, not even 50.5%, 50 basis points, you had, and it's hard to read up there, but it's actually almost an 8% decline in price. So again, emphasizing that point of the longer term bonds are going to be more sensitive to smaller interest rate movements. But in the context of things, 0.5% is not a huge absolute terms move. Here's the same thing with the 7 to 10 year. Went from 1.91 to 2.28 in terms of yield, and lost about 3% in value. This is this year, by the way. This is earlier in the year when rates spiked up. So why has the risk profile for bonds changed? And we think there's really 4 reasons for that. Each one I'm going to go through in a little bit of detail, but one we really already talked about, which is we've had a long extended period of declining rates. Secondly would be that where we stand today in absolute terms of interest rates is at a low point. Third force, which we could go on for hours, but we think is reflective of what's going on in the bond market, is the popularity of mutual funds and exchange-traded funds, and this tsunami of capital that's gone into that as an asset class over the last 4 or 5 years, and why that's causing, we think, kind of dislocation, artificially high and artificially low yields. And then finally, thanks to regulation, what's happening in terms of supply and liquidity in the market, bond market. So relative changes in yields. I thought this was a good example just to illustrate, again, hitting that point of so if you looked at, think about maybe the 2002, 2003, when Fed funds rate were around 5%, and what happened to bonds when there was a rise in the Fed funds rate. And essentially, you think about it in percentage terms, if the Fed moves rates from 5% to 5.5%, essentially it's a 10% move, and everybody can do the math on that. But what's interesting is if you look at where we stand today, that same 0.5% move, which literally could happen in 1 or 2 Fed meetings, is a 200% move in percentage terms. So while in absolute terms it's not huge, percentage, and again, remember that fulcrum, how sensitive. So if we got into a period where the Fed, which by the way, our outside research right now has about a 40% weighting that they'll raise rates in September, and a 50% chance in December, and then a 10% chance that they won't start until next year. So we're fairly confident that the Fed will probably try to get it, at least the first one, out of the way. Markets already anticipated it. And but again, think about where we are now, to 0.25%, to get back up to 4 or 5% Fed funds rate, percentage-wise, is a huge move. So very concerned about potential. This chart actually just emphasizes the growth of mutual funds and exchange-traded funds in terms of assets. So, as Richard had pointed out, there's very few firms now that actually buy individual bonds. Certainly a lot easier, and if you're a wirehouse broker, you get more compensation by putting somebody in a bond fund product than you do trying to pick individual bonds. So, but this really illustrates it. And so what's happened, though, is it's also been dominated by a few players. So there's a few fund families, which I'll remain nameless, but have garnered a lot of the capital. And so they have so many dollars to put to work. They're chasing issues that have to have wide or mass distribution. In other words, if they can't go out and buy bonds that only have a $5 or $10 million issuance, because they literally have hundreds of millions of dollars to put to work. So it's driven the investment grade and the real high quality, the GE, the Apple bonds, those sort of things with a huge float, to very high prices.
So Gary, you said the total bond market was 20 trillion. So even though it's, the amount that's tied up in mutual funds has doubled over the last 7 years, it's still less than 10% of the total.
It is, yeah, it is lower. And you think, who are the buyers of bonds, individual bonds, government debt, and so is a recipient of a lot of that. And insurance companies, banks, that's where a lot of the capital resides. This is more the retail side of it.
They go invest.
Yeah, exactly. So big insurance companies are just going to, they're not gonna obviously use a fund, and there's tons of dollars in that area. But you're right, it is. But percentage-wise, kind of at the margin, it's had a huge increase. Why the demand from retail? No surprise, aging demographics as clients get towards and into retirement tend to use more fixed income securities as opposed to equities. And you could just see over the last 40, 50 years where the average age has gone from around 30 years to almost 40. And this is just the U.S. population. So. The last thing I was going to touch upon is, and I put a question mark because right now there's no liquidity crisis in bonds, but there's certainly the potential for that. Just to note, bonds are traded over the counter, so they're not on a wide exchange like stocks. You can literally go and buy 100 shares of GE and have it executed within milliseconds. Bonds are very much dependent upon what's available when you go to buy them, and they're negotiated transactions. So there's still live people on either side of the equation trading bonds. And so when you get into times of stress, there's that potential for tying up liquidity and not being able to trade the bonds as prevalently. Talking about Dodd-Frank. So after the the financial crisis, government came out with Dodd-Frank and basically required that most banks who were the big market makers in bonds have to exit, mainly because they abuse the system, have to exit as participants. So they're the ones that would step in, provide the liquidity, but that's just shrunk dramatically. It hasn't been really an issue so far, but it really hasn't been tested either. There haven't been periods of mass redemptions or requests for redemptions. So we think it's a big risk, which this hasn't been the case. We go back to thinking about why this could be different this time, is the fact that if you get into a period, and even in 08, there was, liquidity out there. Maybe prices were low, but it was, so we think it could be an issue. And it hasn't really been tested. And this just illustrates how dealer inventory has shrunk at banks. And so just the different colors are the different sectors: investment grade, high yield, commercial paper, mortgage-backed securities. And you can see big spike in 07, 08. No surprise there with the issuance of mortgages and what was that, junk mortgages. But that's really shrunk, and a lot of that's due to regulation. So what do? One option is you could avoid bonds altogether. Not really a viable option for most investors. They do provide stability in a portfolio. They provide an income stream. And certainly you don't want to put all your eggs in one basket in the stock market. So for most investors, that's not really an alternative. There's short-term bond funds that are available, as you probably know. The challenge there is you're going to be, you're pulled together with other investors. So if we do get a period of, and even for short-term bonds, if we get in a period of stress, think of it as, the portfolio manager sitting on this pot of money that all of a sudden getting these cash redemption requests and may have perfectly good bonds, but has to send them out at a fire sale to raise cash. So even the shorter term funds could see a fair amount of volatility. One of the good things that has come about in the last 5 or 6 years are these exchange-traded funds that actually, I put in quotes, have a maturity. So they'll populate the portfolio with a basket of bonds that have a set maturity. So you can buy these out there that are 2015, 2016, 2017. They have them available in investment grade corporates, municipals, high yield, and it's literally an index. So all the bonds will be out of the portfolio at that end of that date. So theoretically, that and we use them. We think they can provide a lot of protection if we get into an unexpected rate rise environment. So, and they're very low cost. Guggenheim is the biggest sponsor of these, called bullet shares. So bullet shares corporate 2017 would have if you have smaller dollar amounts, but you're concerned about putting money into a bond fund, you can buy this portfolio and have wide diversification for a smaller investment amount, very low cost fees, and yet all the bonds are going to mature. So you eliminate some of that risk that's inherent in bond mutual funds. And then our bias, which is kind of the old-fashioned build a customized bond ladder. Call it a lost art because literally there are fewer and fewer firms that do it. One, it's time intensive. It's negotiated transactions. So why that's important is having an open architecture. We use TD Ameritrade or Charles Schwab as a custodian. They have their own inventory, but they don't require us to buy out of that. So it gives us the flexibility to work with about a dozen different boutique bond dealers that we can access inventory to. If you're beholden to one brokerage firm, they're going to make you buy whatever's on their platform.
Hey, Gary, on those bullet shares on the previous slide, I guess there's no staggered maturity date, that if you're in that bullet share 2017, as you approach 2017, the value of that mutual fund is going to decline to face value.
Well, they'll approach their par value, so then it depends on if they're trading at a premium or a discount at this point.
At these bullet shares, you would probably want to have multiple dates.
Yeah, exactly. You wouldn't buy just one,
Right.
Unless you had a specific reason you needed to put, money away for 2 years. But we typically stagger them out, and they'll go. I think they keep every year they'll recycle and come out with another year out. Right now, I think you can go out as far as 22 or 21. But to your point, one of the things I didn't mention is as it gets closer and closer to maturity, and really the last year, we try to sell out and move to kind of replace with a further out ladder before the last year, because essentially it goes to cash. In the last 6 months, you might as well be in a money fund. So, not really risk, but no yield either. So,
on the bullet shares, what kind of a return do you get?
it depends on. It's going to depend on if you're buying high yield corporates, munis. I think Linda, do you know off the top of your head what the yield is? Maybe a couple of years out, probably
It really varies depending on if it's corporate or high yield.
Yeah.
I think they go from like 1.5% yield to even like a 4% depending on the maturity and the underlying.
It's not exciting by any means, but from a risk standpoint, it can really, we view what are the strategies that are going to get our clients and bridge the gap from where we are today to a normal rate environment. And so that's just one of the tools.
But you'd probably get the same on the bond ladder, wouldn't you?
Well, I'll talk a little bit about that. Yes and no.
Here,
Yep.
I was gonna say, what I've been using the bullet shares is for IRAs required minimum distribution. So if I know in 17 marker and say 16, I'm gonna need X number of dollars, I'll buy the bullet share for 17 and sell out. But, so I'm just parking that little chunk of cash there knowing I'm gonna need it before.
Yeah, yeah. That's a good point.
When you talk about a normal rate environment, it seems to me as if we are in a normal rate environment. You were talking about the historical normal rate environment.
Yeah, in terms of a historical context.
Okay.
Yeah, Fed funds at 25 basis points is really an emergency procedure to get the economy back on its feet. Now, we've been there for longer than we ever have. We never even reached that point. So it's hard to, that's what's normal the last 5 or 6 years. But if you look at context of 40, 50 years, we should be at 4 or 5%. Scale matters when you're buying individual bonds. We say that to a point, back to what I was talking about earlier with these large, huge mutual funds that have so many dollars put to work. You want to be buying enough bonds at one time to get a good price. If you're buying $10,000, $20,000, $30,000 pieces, there's a lot of spread built in there, so your price isn't going to be attractive. We typically are buying $1 to $5 million lots, and then we allocate those across our clients that need bonds. So we have some pricing power there. However, in the institutional bond world, those are really odd lots. So there's an opportunity to pick up some extra yield because you're buying issues that the big player, banks, insurance companies, mutual funds are not even going to, won't put a dent in the amount of capital they have to put to work. So you can, as a result, there's some more attractive yields that are available. The other benefit is you can control the maturities, sector exposure, as opposed to buying the index. Index, you're basically going to be driven by, obviously depending on the index, but if you do the aggregate bond index, it's purely built on who's issuing the most debt. So back in 2008, it was mortgage-backed securities was the biggest chunk. Now it's the U.S. government, but you can't really target where you want to have exposure. Energy has been a huge issuer of bonds over the last 7 or 8 years, and we all know what's happened to energy in the last 6 months. Their bonds have reflected that. Been one of the very poor performing areas. So if you buy an index, you're going to own that whether you like it or not. Quality and cash flow. So we have clients that we build bond portfolios, kind of to Linda's point about maybe they have a specific cash flow need, whether it's an RMD, education funding, and we can design bonds that'll structure to provide a predictable either maturity or income stream along the way, which you can't do with a fund. And we usually recommend 15 to 20 issues. You don't want to have too many, and it gets cost prohibitive if we build out a portfolio. We're buying about 15 to 20 individual. It gives us enough exposure across sectors and asset class to be able to diversify the risk. And finally, it's doing a bond ladder, building a customized bond ladder. It takes time. We try to suggest client comes in with cash. It could take 6 months to a year actually to build out the bond side of the portfolio. It's really dependent upon what's available as you try to invest the dollars. I did want to talk a little bit about rating agencies. We take them somewhat with a grain of salt. But there's the big concern out there is the inherent conflict of interest that S&P, Moody's, and Fitch have. They get paid by the issuers. You can do the math on that one. Egan-Jones is one that actually is subscriber paid. So those that are buying Egan-Jones research are the ones that are paying for the ratings and the research. So big difference. Obviously the most prevalent example, Lehman Brothers, was an A-rated bond on Friday, and Monday was in bankruptcy. So it doesn't mean they're bad, the rating agencies, but it's a guide. We look at them, but it's not our only consideration when we buy bonds. Talked about this before. Pensions, insurance companies, banks, and most widely held mutual funds are just limited to investment grade bonds, so that eliminates any other non-rated or investment bonds that are just below investment grade. And we have clients that have constraints that are the same, say investment grade only. But if we have more flexibility, we can pick up some incremental yield by either going just below investment grade. We're not trying to be speculative, but it's again, thinking about investment grade is driven by the rating agencies. So the big three draw the line. And if you don't have a ton of confidence, on the upside or the downside with them, it means there's potentially opportunities. So we do a lot of our own underlying research of the entity, the company, make sure we're confident that they're going to be able to pay off at maturity. And whereas if you're working purely on ratings or limiting yourself to investment grade, that's where most of the dollars have gone. So there's a big spread between, if you remember the corporate bonds yield were 3.3%, high yield, so that includes all junk bonds, I guess, but is 7.5%. So somewhere in the middle there, if you're willing to step out a little bit, you can pick up some additional yield.
Gary, what is investment grade again? Is it A, double A? What is it?
Well, it depends. Each one, it's a little bit different, but it's it'd actually be what, B minus for S&P. Believe it's actually, we can get you the grid, but it's A, I think, for S&P, and then Moody's is B minus, but you have to, and Fitch has their own home structure too. This was an interesting chart. If we think about where yields are heading, the little dots are what the professional forecasters in every period forecasted where interest rates are going to be. And then the solid line is what actually happened. You can see where we are today. We did spike up a little bit, but everybody on earth is buying shorter term bonds and expecting interest rates to go up. So that could be a counterintuitive argument to say, hey, maybe historically they haven't done too good of a job predicting that. So we don't think there's going to be a huge spike in rates. We do think they're going to ramp up, and it's all going to be driven by inflation and jobs and what the Fed funds does, and certainly the underlying economy. So that's the end of my presentation. Anybody have any other specific questions? Richard will be back, I think, here shortly. He's our. Oh, there he is. Richard drives all the fixed income purchases for Carnegie, so you can put all the hard questions to him.
I did have a question on this. You focused on the bond liquidity issue, and I guess I didn't realize that was a factor in terms of being able to sell the bond if you wanted to get out of the issue early. And so if the banks, because of the regulation, I thought that really I thought investment banks who trade could continue to do that, or traders could step in and fill that gap on the liquidity issue, but I'm surprised no one has really stepped in to capture that. It seems to me if they were making money doing it before, why hasn't someone stepped in and taken over that role?
Well, for banks, it became it became an issue because if that's part of their trading dollars, they couldn't count that as part of their reserve dollars, and so it became a liability on their books. And as little as 2007, some investment banks like the Goldman Sachs was highly levered, 40 times what their capital base is. Today they're like 10, 11 times levered, much less leverage. So having a trading desk with millions or billions of dollars in like a Citigroup side or a JP Morgan, it became a lot. While it's a potential trading source, it became a liability on the bank side. And what's interesting is we've always thought banks make decisions for the benefit of the bank, not their clients. And so the people who would normally step up in a crisis, those dollars are just not there. And with over the last 8 years, that the firms that we talk to, so 98% of the bonds we buy from small little bond boutique firms that's what they do for a living. They're seeing just the inventory shrink. It's actually good for them because of the big trading banks aren't, they're simply not as robust as they once were. But we could really foresee an issue where if we have a spike in rates and these huge multi-billion dollar, 20 years ago there wasn't a bond fund that was over 50 billion. Today there's a dozen. $50 billion bond funds, and if they have to start liquidating because there's dollars going out the door, and almost universally most retail bond mutual funds are retail investors, which means those are the first guys that want to exit from the doors. It's not institutional firms or pension firms. So it'll be interesting when a crisis happens, and there will always be a crisis. There's always going to be wars. There's always going to be recessions. There's always going to be an issue that is going to cause problems. And we think some of the results in the Dodd-Frank bill, it's not going to end well.
So I guess my point is then, say you have a significant amount of bonds, should you be more diversified in terms of something that is more liquid, even though it has a lower return, such as a CD or whatever?
Well, it's a good question, and it gets back to one thing. Everybody's case is a little bit different. So one thing that we really strive on is, what the market does is one thing, it's a little bit different. Our goal is to make sure each client reaches their particular objective. And if a client's particular objective is, I need in my portfolio to create $6,000 a month in income, that's what it should do. It really doesn't matter. If we do that as defensively as possible, and liquidity in bonds is only an issue if
You want to sell them?
Exactly. Exactly. You know, and judging, making a decision on a bond's merits is night and day making an investment decision on the stock. And most people are hardwired to think about a company stock. So, you know, you want to invest in a company that's growing. As a stock investor, you're looking for a company that 5 years from now, their earnings are higher and better. If I'm buying a bond, it's maybe a callous statement, but I really don't care about their underlying future growth prospects. All I care about is the cash flow and their ability to pay that debt off. So to hold it, you know, I become a lender, if you will. I'm like a banker thinking about, you have the ability to pay that debt off. So it's a different calculation. And for a client who wants to and needs to have non-equity dollars in the market, what's the best place for those dollars to be for that client.
Yeah, and I would just reiterate, when we buy bonds and construct a portfolio, it's with the intention of holding it to maturity. We don't trade bonds, very rarely, unless we're getting it, which we have a couple of times in the last few years, gotten a crazy offer on a bond that somebody knows we own. But if there's a concern about needing, a tremendous amount of liquidity in the portfolio, we probably take a little more, different approach. So.
Richard, I've got a question for you. When you have purchased a large number of bonds, okay, how do you allocate them? What are you looking at as clients? Is it the need? Is it maturity dates of the bonds they already hold to replace them? What is it that you look at?
It's all the above. It really depends. A very real story. We bought 18 months ago a bond, Lidos, which means nothing to anybody here, but it's just a software company. We've had the bonds in the portfolio. We've got $2.5 million on the books. And the bond world is very transparent. Everybody knows, all trading firms know what bonds we have on our books. They don't know the securities, they don't know the QSIPs. So 1,000 of these became available, and we have in our, for clients, we have identified this particular client's looking for investment grade bonds, 6 years or under, etc. So we always have cash available for the right opportunity. It comes along. Sometimes cash is a good thing, and it gives you the ability to take advantage of it. So when these 1,000 bonds came available today, I know we're looking for about $1,800 of corporates that mature in 2020. We're able to get them at par on a 4.5% coupon. We're comfortable with the credit. We know who it is. They needed to make a liquidation and to come up with $1 million. We have the capital. We were able to do it. So the allocation was kind of done in advance, if you will. We know one client needs 50, one client needs 25. It adds up. It's roughly 1,800. So it pre-populates into those clients that need it. And then if they already have it, the clients that have the $2.5 million, we're not going to add more to it. We wouldn't double up on a name in a particular client's holding. Does that make sense?
Yes, it does. Thank you.
What are the total assets that you manage from a bond perspective at Carnegie, and how has that changed over the last 5 years?
It's about $400 million today, and it's probably tripled in the last 5 years, if you will. Again, I think it's very much a lost art. We actually manage money for 3 other firms that are in our business, but they just don't have the skill set. Unlike stocks, buying bonds is a negotiated transaction, between 2 people, and everybody in the room could pick 3 stocks, and we all push a button and it happens. It's very efficient. The custodians we use, it's a very efficient trading desk. In a bond, it's a negotiated transaction. I don't like your price. I'm not going to buy it. Here's my price. Pound salt. Go to somebody else. Today, there's probably a half dozen firms in the state of Ohio that do it like we do, with the volume that have the means and resources to do it. And don't just look at the very basic chart and say every client needs a 30-year bond, 20-year bond, 15-year bond, like a trust department. Other firms that just don't have the capability, and if you don't have a Bloomberg, quite frankly, I think it's like you're throwing darts in the dark without knowing how these things have traded in the past to be able to make a bid. So, hey, Mike.
Sorry. Of that $400 million you have invested in bonds, what percentage would you say is in municipal bonds, and what's your perceived risk associated with munis these days?
The perceived risk is a lot less than it was 5 years ago, and even less than it was 10 years ago, actually. Coupled with, to answer the first question, we have maybe 150 million in munis, and the rest would be corporate or taxable munis. But just like corporations have gotten did a lot of belt tightening with interest rates coming down, cities and counties and municipalities have too. Now, there's always those Louisiana, Chicago, Puerto Rico. There's always those kind of outliers. We all know about what happened in Detroit. Some of that's like known problems, so you see those. But percentages, the actual strength of the typical city, county, municipal is better than it was 10 years ago. Partly because 10 years ago you're paying 4.5% on your muni debt. Today you're paying 2.5%. I'm flabbergasted at the ability for investment banking firms to be able to raise money for some of these very small municipalities here in the state of Ohio and issue paper at less than 1% or 1.5% in go out 10 years. I mean, I'm just not willing to loan. They may have great credit, but City of Independence, Ohio, can give them money, client money for 10 years and get a 2% return. It's tax-free, it's nice, they have good credit. Same thing with Beechwood or something. Great. To the risk-reward return, it's just not worth it. So because they've been able to refinance at such low interest rates, though, the fiscal strength of cities and municipalities is better than it was 3 years ago, 5 years ago, even 10 years ago, before the crisis. Hey, Sandy, any questions? Well, thanks, everybody.
Yeah, just.